Why is the market crashing and how far is it going to go? We're going to talk about it in this video. We're going to look at some charts and also some data. We'll talk about potentially how far the market could pull back from where it's at right now, if it is going to keep pulling back at all. And we'll take a look at the narrative that's currently playing out. And by the way, if you guys want to see more of my charts, more of my analyses, you can do so by using the link down in the description for the Discord. Thousands of members, vibrant community, tons of trading every day, including live trading, typically at 2 p.m. You can also check that out. That's led by StockMo. You got panel experts over there as well, and it is active, buzzing, and you can see those trade wins coming in every day. And by the way, there's a coupon code right now, cash, for 50% off your first month when you sign up. All right, that out of the way, let's move into the data that we have and the charts. So I'm going to take a little spin around here, and we're going to pop over to the charts to see where we've fallen so far. So right now, looking at the monthly chart for SPY, you can see right now that we barely even started dipping in terms of a monthly basis. I know that it's been painful so far, down just at this month alone over 5%, and then definitely off of that from peak down to trough so far. But you can see that we've had an incredible ride up, and really you should be looking for this area down here. Things are going to get really painful, really tough. You should be looking at the previous peak that we had back in 2022, and then the trough that we had all the way at the end of 2022. And I think the peak is going to be more important and more telling for what we have, unless we get into some really bad way. Now, and again, this is only if we do continue to fall, so don't say that as you look at this, that we're absolutely going to make this happen. Right now, the narrative is economic weakness. What are we going to do about this? We could potentially have a recession on our hands. Trump said that it's probably going to be a little bit worse before it gets better. So there's just a lot of rattling in the market that's going on right now, and just a lot of drama that's going on around the world. And the market's going to absolutely hate all of the different uncertainty that happens to be out there. So like I said, we've barely started falling. Watch this 20-month moving average that we have. You can see the bounce that we took off of that back in October of 2023. And then below that is the 50-month that we're looking at, this pink line right here. And if you look when we hit that 50 October of 2022 when the market took its just a rampant run after that. When else did we hit it? Well, the pandemic shoved us down below that 50-month just for a little bit in time. When we ended up closing, it was just below the 50. That next month that came around, April of 2020, we shot back not only above the 50, but up the 20 and then rallied on. So we have some things to watch out for. 525 is about where that 20 period is right now. And then the 50 period is about 461 and still climbing on us, just so you know. So these two might end up meeting each other if we do continue to sell off. Hitting the 200 day would just be 200 month, I think would be absolutely disastrous. So that's something that we want to watch out for. If we go over to the monthly chart for the Qs, it's going to be a lot the same that when you go and look at October of 22, that's when we're messing around with that 50 month. And then we didn't even get down to the 20 or the 50 when it came to October of 2023. And I guess you could say thank you to the AI trades and the big tech movements that we had during that time that really kept us away from that. So if we go back even further, this is March of 2020, which kept us up above the 50 month. And that was pretty incredible to watch the market pull back as hard as it did. So are we in better or worse times right now? I think in terms of the pandemic, I would say that we're in much better terms, a much better state of things. And so that's, in my case, a pretty positive thing to look out for. Now, in terms of recession, that's something that, can be pretty scary for the markets. And well, we want to be prepared for what to watch for on the way down so that we can watch for what to get on the way back up. And so I just want to take a long-term view on this. And if you take a look at the RSI, which is at the bottom of your screen here, we don't have to dip very far into bearish territory for there to be a lot of pain. And we honestly don't even get there very often. You have to go back to the Great Recession for us to ride on that line of overbought where oversold, where you spent just a bit of time down at the bottom of this thing before ripping back up. So on a monthly basis, if you're looking at these charts, if you're looking at the RSI, we have the moving averages. The 20 and the 50 are probably about what we can look for those potential big supports to come in. So we might fall through some other ones along the way if we continue in a downward trajectory. But those are exactly what I'm watching. And as per the RSI, getting down and crossing down below 50, unless we get into a really dark period financially and economically, that's what we want to watch for. And now, mind you, the Fed is still keeping interest rates pretty darn high, and that'll actually lead me into the data that I'm going to discuss. So I'm going to take this down, and what we're going to do is instead start looking at some of the pillars that I had talked about in this video. Now, mind you, there's 4 pillars that I had mentioned on this. So those 4 pillars that I've been discussing is that we want high GDP. That would help to prop up the market. Each of these pillars props up the market. We also want subdued inflation, and then we also want a stable labor market, and then we also want easy monetary policy. And each one of those right now is in question at the moment, and that is why we're seeing the pain that we are. So if that narrative continues, and if that's what we're currently running with in the markets, then I think that we continue to experience more pain. And if any one of those pillars crumble, it can really cascade throughout the other ones and be a chain reaction effect. Now, mind you, we haven't had those pillars completely fall apart in a very, very long time. So a Great Recession of 2008 would be a time where we actually had a collapsing one of those pillars that starts to take out the other ones as well. Now, mind you, then we hit a period of easy monetary policy, and we also hit very much subdued inflation. And so that also helped to bring back what we saw for GDP, and that also led to a strong labor market. So we had that rebuilding time of things. So let's look at the data here. So popping this back up for you, what we're looking at is there we go, the Atlanta Fed GDP now. And this is what we're seeing for those cracks in the pillar for strong GDP, is that right now it's looking like this quarter is not going to be great. March the 28th is the last update that we get for Atlanta Fed GDP now, and then April the 30th is our advanced estimate that we get. So we're still a month and a half away from getting the advanced estimate for GDP for Q1. So, as long as this narrative stays around, if we don't see a recovery for that GDP, well, that can be concerning for us. Now, mind you, if we bring up the national debt clock, and I know that this is a mess, but if we bring up this part right here, and I want to draw your attention just to this part right here where it says now 122%, this is the debt to GDP ratio. Well, the debt's going to be hard to move, but the GDP, if the GDP happens to collapse, and that being a denominator of a fraction, when the denominator of a fraction gets smaller, the overall value of the fraction tends to get bigger. That's holding the numerator constant. So keep the top the same. The debt doesn't really change that much in a hurry. And then that bottom part, that GDP part of it, that can absolutely change quickly. So the top is going to stay the same number. The bottom one's going to get smaller. So imagine 10 divided by 10 is 1. 10 divided by 5 is now 2. 10 divided by 1 is now 10. So when you look at that, if we have a contracting GDP, if that GDP shrinks, then this debt to GDP starts to become a higher enough percentage that it starts to become unmanageable, and that can lead to credit downgrades. And if the U.S. were to ever miss a debt payment, that right there that'd be a huge disaster if it defaulted on its debt. So if we go over here, you can see that trajectory over time from going all the way back to, it looks like, let me see, where does this thing start? 1966 until present. This is debt to GDP according to the St. Louis Fed data that you have. And yeah, we pulled back from where we peaked out in the early part of the pandemic, but then we started to climb that debt to GDP ratio. So not necessarily good for us when we look at that. So that GDP weakness can also mess with the whole debt crisis that we're currently under right now, which can spell further fear, uncertainty, and doubt into the market. And that's, again, why we're seeing what we're seeing. And I mentioned subdued inflation. So if we look at the CPI, which is coming out soon, right now, sitting above 3%, that'd be nicer down around 2%. Now, we have the tariffs that everybody's talking about. If that pushes inflation up, that pillar starts to crumble as well, and that destabilizes the market. And that's part of what we're seeing, is that thought that inflation is going to remain higher for longer, and it could increase in the face of the tariffs. So that's why you have that inflation rate going up. And now, mind you, something to pay attention to for that, and maybe I should face this other camera for this one, if the inflation rate goes up, that actually decreases the value of U.S. treasuries, especially the long-term treasuries, because it eats away the profitability of that treasury. It diminishes the long-term value of that treasury. So less people want it, which means that the interest rate goes up, which means that it's even harder to service debt, which increases the debt crisis. So you just get just this vicious circle, if you will, of trouble that can happen, and the market will run with these narratives if they can. And we want to be watchful for these, for implications where we can expect and anticipate that it's going to happen. And we also want to expect and anticipate when there's a narrative shift that can also happen for us. So the last thing I want to put up here is the CME FedWatch tool. And this is just looking at December of 2025. And 1 month ago, we were looking at just 125 basis point cut from where we currently exist right now. So that would be this part right here, this bar. And you can see just how low it is. That's now at 6%, whereas before, a month ago, it was at 37%. And so now we're here. This peak is now at 3.5 to 3.75% for the federal funds rate. Well, that's also something that we want to pay attention to because, well, inflation's still expected to climb. So why would the Fed cut their rates, or why would the anticipation be, according to the bond market, that the Fed would cut their rates? And well, economic weakness then would be one of those things that would be like, maybe we have to pull back on this, in which case, if there is economic weakness, if the people stop consuming, if companies lose pricing power, then inflation will subside, but we don't want it to subside in the face of economic weakness. We want it to be supply side driven, where there's so much productivity and so much consumption happening that those prices relax themselves over time anyway, and then we get the soft landing. Well, right now, the market just is not running with that. So we have some considerations to make. As we watch the market play out right now, I have my technicals available over at the Discord this week. I am the expert of the week in the Discord, so you can see my showcase there, and then you can also see my channel where I post more of my technicals and my trades, but then there's other experts in there as well who post their trades, and you can see that, and you can check out even the community wins. You can watch and see what they do, and Stockmo's over there as well. Crypto Will, if you want to know all things crypto, he's the crypto expert. I talk Bitcoin, I talk XRP, and maybe some other emerging cryptos that you might have out there on occasion, but he really covers it in depth. Guys, thousands of members over there, a vibrant community. Why not be part of it? Code word cash is going to be, at this point in time, with that code word cash, saving you 50% on that first month. It ends up coming down to less than $1 a day. Even after that goes away, you're still looking at under $2 a day to get access to tons of information, tons of trades that are out there. And then there's also some coursework that goes along. Down in the description, you can find that for Stockmo Academy. You can sign up using that link for that. Use the code word doctor when you sign up, and that's also going to give you a massive discount on those courses. You can learn about technical analysis trading using the bread recipe, and then also you have the options course over there as well, where you can really learn how to really leverage those gains that are your opportunities in the markets, if you will. And like I said, all that available down in the description. Guys, let me know what you think down in the comments. Even if you just like to say hello, I'd love to hear from you. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning. We'll see you next video.